So I just took this trade, as you can see clearly. So I just hit my take profit. It was a 1 to 2 risk to reward trade. So it simply meant whatever value I risk in taking this trade, I made 2 times, right? So I'm going to take you through the analysis, what I saw and why I took this trade. But before that, let me just show you the proof. This is the proof. As you can see, I took the trade on MXC. So you are seeing my name there, Senna Coffee. You are seeing the dates. Every single thing shows out right here. My entry and then the closing price. Everything just shows, right? So you can verify whether this trade indeed I took it or not. This is the verification code. So let's go through the analysis, what I saw and why I took the trade. So clearly, this is the 1 hour time frame. So clearly on the 1 hour time frame, we are seeing that the market is in a downtrend. Now, if you are someone who trades based on chart pattern, right? So there are a lot of ways you can execute trades. Sometimes you can execute trades through just learning chart patterns, right? So if you learn your chart pattern and you know what is going on, rightly you get to know that the market was about to hit a downtrend, right? Because this is more like shoulder, head, shoulder. And if you've been on the market for a while, you know that a very common chart pattern, if the market wants to go down, is to form head and shoulder pattern. So this is head and shoulder, this is the head, this is the shoulder, this is the shoulder, right? So clearly you see that the market is in a downtrend, because if the market is in a downtrend, what it does is you have lower lows and lower highs. So on the 1 hour time frame, you saw that the market here, lower low, lower high, lower low, lower high, right? So I was sort of tracing the market from this area. So right here, it also printed a lower low, and then right here, it printed a lower high. Okay, now this lower low was broken. This lower low was broken by this one. So here we had a break of structure. Okay, we had a break of structure here because this low was then broken by this one. So when the market breaks a structure in a downtrend, now what happens is you expect the market to retrace. Okay, so once the market retraces, you expect another break of structure. So exactly that's what happened. So when the market broke this structure, okay, it came back up. Now I have noticed that most often if the market is retracing, it retraces into a supply. This is a downtrend, and so the market will retrace into a supply area. So an area of supply basically is where a lot of sellers are waiting for the market to sort of get back to, so they'll still send the market down. So that's the area of supply. Now, how do you determine an area of supply? You determine an area of supply by marking out the last green candle as the market's printed a large red candle. So right here, you realize that when this low got printed and the market went up, we had 2 large red candles, this and this. So the last green candle is this. So here obviously is our area of supply. So once the market broke this structure, I knew that the market will be retracing and coming back to our area of supply. And that's exactly what happened. The market indeed retraced and came back to our area of supply. And what happened? Came back down and broke this structure. So it's very simple. We are in a downtrend. Market continuously breaks structure. So once the market broke this structure as well, I marked this structure out. The market here broke it. So what was I waiting for? I was waiting for the market to retrace into area of supply that was created by breaking of this structure. So the area of supply that was created by the breaking of this structure, as you can see clearly, is this large green candle. basically. So let me take it once more. So here, the market broke structure here, right? This candle broke this structure. When this candle broke this structure, you expect the market to retrace into an area of supply. Area of supply is the large green candle that prints before you have large red candles, right? So here, the market retraced. Here, this one broke this structure. Okay, this was the new low. The new low was broken by this long red candles. What caused the break of this long red candles? The last green candle, right? This last green candle that was printed. This is the one that caused the break of this structure. So what do? I just wait for the market to retrace and come back into this area and expect the market to come down and at least, even if it's not going to break, at least come near the break of or come near this particular low. Now, why I'm saying even if the market is not expected to break, the reason why I'm saying that is sometimes the market can come close and then it will not break the structure and then go up. Usually when it happens that way, it tells you that the market wants to change character, right? And so you see where I placed my stop loss. Initially, I should have placed my stop loss beneath this level, but I just knew that no, the market might decide to, just come here and then change character. So to be on the safer side, I'll just place it somewhere here, right? And then it was a cool 1 to 2 risk to reward. So basically, when the market retraced here into my supply region, when it came back into my supply region, all I was waiting for was a reaction. So when the market came here, okay, we are seeing what happened. The market was in an uptrend when it was retracing into my supply region. So higher high, higher low, higher high, higher low, higher high, higher low, higher high, and then it printed a red candle and another red candle that broke this mini structure. So as the market broke this mini structure, I knew that the market really wanted to come back down. But then as it broke the mini structure, I was expecting the market to sort of retrace back into this area. And so when the market got here and it printed another red candle, I just took the trade from here and then I placed my stop loss. Now, one thing that saves me a lot from trades like this, because you see, sometimes in trading, it is not always about getting the direction right. Sometimes you can get the direction right, but you still lose a trade, and it might be a result of where you placed your stop loss. Now, one thing I've learned about trading is to place my stop loss, especially if it's in a downtrend. One thing I've learned is to place my stop loss above a protected high. Now, what do you call a protected high? Let me just explain so you understand. So you see, the market moves in, the market has a direction. Let me explain. So I think I've said this in my videos. The market has a direction. So if the market is coming in a downtrend, it will come back, it will come down, go back up a step, come down, go back up a step, come down, go back up a step, and then come down, right? The market can move in this direction. So in a downtrend, this is how the market moves. Now, a protected high is a high that caused the break of a previous low. So this is a low. The market came back up. This is a high, lower high. And this lower high caused the break of this low. So this place is a protected high. So you see that it continues. So this place is a protected high. Why? Because it caused the break of this low. Now, this is not a protected high. Why? Because indeed it came back down, but it has not broken this low yet. So it is not a protected high. So sometimes the mistake is that you get the market, you get the structure right, you get your direction right. But when you take a trade and then you place a stop loss here, you can be taken out. And that's the same thing that happened here. So what I do, a rule I use is, if I'm taking a trade, I make sure I place my stop loss above a protected high. That is if I am shorting the market. But if I am longing the market, okay, and the market is going up, right, and I'm taking a trade, I place the trade here, a protected low. Why? Because this low caused the break of this particular high. Now, the reason why you need to take trades this way is because now if the market breaks, yes, you can place, okay, so the market is coming down, right? So yes, you can take a trade and place your stop loss here, right? Because this is a protected high, and still you can be taken out still, right? You can still lose the trade. You can be taken out. But what this means is that if you get taken out, then it is a confirmation that the market is moving in a different direction. And so in that case, you can take the trade in the opposite direction. So imagine that you were taking the trade and you wanted the market to go down, and then you were taken out. So it simply means that now the market is changing direction. So if you were shorting the market, now you can long the market. And that's, for me personally, the reason why I take trades and then place my stop loss above the protected levels. So right here, you see that when the market printed this low and it came back here and then caused the break of this low, I knew that this area obviously was a protected high. And so when the market got here and I was taking the trade, someone, right, easily could have just taken the trade and made sure they'll place the stop loss here, because the person will think that, okay, this is a low. So the person will place the stop loss here. Now what happened? If you place a stop loss here, right, you see that the market came back up and took all those people out. It came back up and printed a little above that area. And so if you placed your stop loss here, this area has not broken a level yet. And that was a mistake I was doing a lot when I started trading. This area has not broken this level yet. So for me, if you place your trade here, it sometimes it can work out. Sometimes it's going to work out. But for me, I feel like you are just moving in unknown waters. You are swimming in unknown waters, and anything can happen to you. But once you place your stop loss here, you know that this area broke a low. So this area is a protected high. So if it breaks this area, then the market is going up. So this is what I'm doing. So yes, of course. So I took the trade here and I placed my stop loss here. And indeed, as the market came back up, I wasn't perturbed, because it's at the back of my mind that no problem, if this area gets broken, I'll just long the market and we go. So yes, when it got here, the market came back down and now came to my area and then closed in profit. So this is how I took this trade. So you can use this strategy, very simple strategy. You can use this strategy in all the time frames, right? Let me just show you. So let's go to let's say 15 minutes time frame, and then let me show you the 15 minutes time frame, how you can use this strategy in the 15 minutes time frame. So clearly in the 15 minutes, so you see the market obviously here it's in a strong downtrend, and so it wasn't really retracing as much, and that's how you know that the market is in a strong downtrend, if there's no form of retracement. But we saw something here, right? If you are trading on the 15 minutes time frame, so this was a low, and then the market came back up here, and then this low caused the break of, so this low, right, this was a low, the market went back up, and this high now caused the break of this low. So the last green candle was this candle. Okay, so the last green candle was this candle. Now look at what happened. The market indeed, after breaking this low, came back up into the same region, the last green candle region, and what happened? Came back to break or to print beneath the area. And so if you were waiting for the market to come back here, and then the market came back here, and you took the trade, you took the shot from here, and then here the protected low, because this low broke this structure, so protected low, and then sets your your target here, because this was the low that the market got to before coming back up. It's a cool to 1 to 2 1 is to or 1 to 2.5 risks to reward ratio, which is good. So clearly we are seeing what happened. Okay, so clearly that's exactly what happened. And then yeah, so you can just use this strategy in every time frame, or in all the time frames, and you are going to make profits, right? You are going to make a lot of profit. So this is the 1 hour time frame that I used. Let me go back to so that's the 1 hour time frame that I used. So basically this level is where I'll be looking at for the market to sort of retrace. So if the market comes back up and then prints above this level, I know that the market is now going into an uptrend. So in an uptrend, what do? We long the market. We just buy, we don't sell. So now I'll be waiting for the market. If the market goes back to print another level to close beneath here, then I'll just wait for a retracement back into this region, and then we go down further. So once you're able to trade this way, you are good to go. So share your thoughts in the comment box. Thank you.